As I speak to you right now, Nvidia is trading at $185.22, up roughly 0.12% on the intraday session, bouncing off a low of $183.67. We are seeing a market cap hovering right around $4.56 trillion, a figure that is frankly difficult to comprehend even for seasoned veterans. You might see that green number on your screen and think this is just another standard day for the chip giant. But if you look closer at the order flow and the price action since the opening bell, the reality is far more aggressive. We are seeing a massive compression in volatility, a coiling spring effect that usually precedes a violent move. Yet the retail crowd is sitting on their hands, waiting for a signal that the institutions have likely already acted on. The expectation right now, especially after the Consumer Electronics Show keynote just a few days ago, was that we would be seeing a massive breakout above the 190 level. Investors expected the announcement of the Rubin platform to immediately send this stock into the stratosphere, reigniting the explosive runs we saw back in 2024 and 2025. But here is the cold reality that is catching thousands of traders off guard. The stock is not ripping. It is chopping. We are seeing a classic sell the news event play out in slow motion, but with a twist that most people are missing. The expectation was that a new chip architecture would instantly translate to stock momentum. But the reality is that the market is now asking a much harder question, which is whether a $4.5 trillion company can realistically grow at 30 or 40% annually from this base. The tension you are feeling in the chart, that refusal to break out past $187, is the smart money asking if the law of large numbers has finally caught up to Jensen Huang. You are looking at a chart that is screaming indecision, and while the retail sentiment on forums like StockTwits has hit extremely bullish levels of 86 out of 100, the price is simply not reflecting that optimism. This divergence between crowd enthusiasm and actual price mechanics is usually where retail traders get hurt the most, buying calls on a breakout that the big banks are actively selling into. Let's strip away the noise and look at what is actually happening today. The volume on this move is telling a very specific story. We are seeing volume spikes on the dips, specifically around that $183 level, which suggests that there is a rigid floor of institutional support preventing a collapse, but there is an equally rigid ceiling of supply right above $187. This is not the behavior of a stock that is about to go parabolic on pure hype. This is the behavior of a stock that is undergoing a massive transfer of ownership from the early momentum chasers to the long-term capital allocators who are building positions for the next 3 to 5 years. The frantic energy of the last 2 years has been replaced by a calculated, almost mechanical accumulation phase. You have to realize that when a company becomes this large, it effectively becomes the market. Nvidia is no longer just a tech stock, it is a macro proxy. When treasury yields tick up, as we saw earlier this week with the 10-year yield pushing toward 5%, Nvidia feels it instantly. The algorithmic trading bots are now linking Nvidia's price action directly to global liquidity conditions, meaning you are fighting the Federal Reserve just as much as you are fighting the bears. Now, I want to talk about the elephant in the room that no one seems to want to address honestly. The Blackwell cycle is in full swing, and we know it is sold out, but the market is a forward-looking mechanism, and it is already trying to price in the Rubin platform. The announcements at CES regarding the Rubin architecture were objectively impressive. Extreme co-design across 6 different chips, a 10 times reduction in inference costs, but the stock dropped 6% on the day of the announcement. Why? Because the market is realizing that efficiency is a double-edged sword. If Nvidia makes their chips too efficient, do their customers need to buy as many of them? It's a counterintuitive fear, but it's one that is circulating in the dark pools and hedge fund notes I've been reading. The expectation is that demand is infinite. The reality is that hyperscalers like Microsoft, Meta, and Google are under immense pressure from their own shareholders to show a return on the hundreds of billions they've already spent. If the Rubin chips allow them to do more with less, we might actually see a deceleration in revenue growth, not because the tech is bad, but because it's too good. This is the paradox that is keeping the stock pinned in this range today. Let's zoom out and look at the broader sentiment, because this is where the psychological battle is being fought. If you go on X or Reddit right now, the frustration is palpable. You have traders who bought in at $190 or $200 during the last hype cycle who are now underwater, watching the rest of the market rotate into other sectors. There's a growing narrative that AI is in a bubble, fueled by reports that 41% of investors think it exactly that. This creates a wall of worry. Every time the stock ticks up $1, you have thousands of nervous bag holders looking to get out at break-even, creating natural selling pressure. On the flip side, you have the buy-the-dip army that has been trained for years that Nvidia only goes up. This clash of panic and greed is what creates this choppy, headache-inducing price action. The retail investor is looking for a hero to save their calls, while the institutional investor is looking for a stable entry point to hedge their exposure. Now, I want you to really think about the scale of what we are discussing. We are talking about a company that controls 92% of the GPU market. That is not a monopoly, that is a hegemony. But with that dominance comes a target. We are seeing headlines about the US government taking a 25% cut of sales to China in exchange for approval, a move that introduces a sovereign tax on Nvidia's earnings. The market hates uncertainty, and this new sovereign tax on AI chips is a variable that algorithms cannot easily price in. This is why you are seeing these sudden air pockets in the stock price, where it drops $2 in minutes without any news. It's risk desks adjusting their models to account for a world where Nvidia's margins are dictated not just by engineering, but by foreign policy. The expectation is that Nvidia is a sovereign entity unto itself. The reality is that it is deeply tethered to the whims of Washington and Beijing. However, we need to balance this fear with the absolute monster of a tailwind that is robotics. Jensen Huang called this the ChatGPT moment for robotics, and the market largely yawned. That is a mistake. If you look at the partnerships announced, Aurora Innovation for autonomous trucking, Toyota, the Cosmos platform, Nvidia is laying the rails for the physical manifestation of AI. The market is currently valuing Nvidia as a data center build-out company, but the smart money is starting to value it as a robotics infrastructure company. The data center build-out was Act 1. Act 2 is putting that intelligence into machines that move. This is a multi-trillion-dollar opportunity that is currently being priced at zero because it hasn't shown up in the quarterly earnings. This is where the opportunity lies for the patient investor. While the day traders are screaming about gamma squeezes and weekly options, the real money is looking at the fact that Nvidia is positioning itself to be the brain of every autonomous machine on the planet. Now, let's get back to the immediate price action. We are currently sitting between a rock and a hard place technically. The support level at $183 is critical. If we lose that, the next major shelf is down at $178. Conversely, we need to reclaim $188 with conviction and volume to invalidate the bearish thesis. Right now, the stock is stuck in no man's land, bouncing between the 20 and 50-day moving averages. This is designed to frustrate you. It is designed to make you sell your position out of boredom right before the move happens. The market makers know that retail traders have the attention span of a gnat, and they are exploiting that by keeping the price in a tight, grinding range. They want you to capitulate so they can buy your shares cheap. We also need to talk about the broader sector context. AMD and Intel are trading today as well, and their movements are lackluster. The semiconductor index is showing signs of fatigue. This tells us that the rising tide lifts all boats phase is over. Now it's a stock picker's market. You can't just blindly buy the ETF and expect to get rich. You have to understand the specific idiosyncratic risks of Nvidia. For instance, the sovereign AI narrative, where nations like Japan, Canada, and France build their own AI supercomputers, is a massive bullish catalyst that is being underreported. These are customers that are not price sensitive. A nation-state doesn't care if the Blackwell chip costs $40,000 or $50,000. They care about national security. Nvidia has effectively become an arms dealer in a digital-tooled war, and business is booming. The disconnect between this geopolitical reality and the board tape action today is massive. I want to pause here and ask you a question because I really want to gauge the sentiment of the people watching this. Comment below how many shares of Nvidia you currently hold, and more importantly, what is your average cost basis? Are you one of the lucky ones who got in pre-split, or are you battling to lower your average right now? I want to see the mix of long-term believers versus short-term traders in the comments section. Moving into the future outlook, we have to consider what the next 3 to 6 months look like. The earnings report coming up in late February is going to be the most scrutinized financial document in history. The expectation is for earnings per share to be around $1.49.